Hey everyone, happy Thanksgiving. In this video, I want to value one of my favorite military stocks, General Dynamics, or GD. If you're new to the channel, my name is Dan. We do a lot of investment analysis on this channel. So if you're into that kind of thing, hit that subscribe button so you can see more of my videos. So with that out of the way, let's get into it. Okay, so never invest in anything that you don't understand. And General Dynamics is pretty easy to understand. They are a military stock. They operate in several different segments here. One of them is aerospace. Then you have combat systems, information technology, including AI, mission systems, and marine systems. So you can see from the pictures the kind of things that they're into. Now, General Dynamics revenue comes from those 5 sources, and they're pretty well diversified. They're not too dependent on any individual segment. As you can see here, here's a breakdown of their revenues from the most recent fiscal year. Okay, so here's a breakdown of the revenue for General Dynamics, whether it's the US government or other customer, for the past 3 years. So the blue represents the US government. And as you can see, the US government counts for a pretty significant portion of their total sales. So that's one thing we have to understand when we value General Dynamics. So what does this mean for the company? Well, accounting researchers have shown that when you have the US government as a major customer, it actually leads to increased efficiencies in your operations and ultimately greater profitability. This is a little bit different than having a major corporate customer where you're entirely dependent upon them, and it can actually result in a higher cost of capital on average. With a US government as your major customer, researchers have shown that it is actually a good thing. Okay, so jumping into the balance sheet here, I see they have a liabilities-to-assets ratio of about 70%, which is on the higher end, but not abnormally high. It looks to be fine. The current ratio is 1.29, so that's greater than 1. They easily cover their current liabilities. That's great. By the way, if you want to know any of these ratios, I put them in the description below. The quick ratio is less than 1, but pretty close to 1. A little worry there, but not much. And the interest coverage ratio is above 9, so the company can easily cover the interest on their debt. So I would say, yes, there are tons of companies with healthier balance sheets, but this company does not look to be particularly in danger to me. So General Dynamics is a roughly $43 billion company. They pay a dividend yield of 2.89%, and their price-earnings ratio is currently 13.74, which makes it very attractive compared to the S&P 500, where the price-to-earnings ratio is above 20. Another reason investors are crazy about General Dynamics is their history of increasing dividends, as you can see from the chart here. They've managed to increase their dividend for 26 straight years, making them a dividend aristocrat. So while getting 2.89% dividend yield doesn't sound very exciting, you got to consider that eventually that yield is going to be huge. Okay, so here are the income statements for General Dynamics for the past 4 years. Plus, I have trailing 12 months, which means I have the first 3 quarters of 2020 plus the last quarter of 2019. So as you can see here, their revenue has generally increased every year. The most recent trailing 12 months period, it actually decreased slightly, but who didn't with COVID going on? And the net income has gone up. I'll bet it's been a little bumpier than you'd like to see, but not too, volatile. If we do a vertical analysis by dividing every number on the income statement by the revenue in that year, what we can see here is their net income is, between 8 and 9% of their revenue every year. That's their net income margin. That's pretty good for a manufacturing company. And one positive I like to see here is their selling, general, and administrative expense as a percentage of revenue has gone down every year. So that is trending downward, perhaps due to greater economies of scale. So return on equity, or ROE, is one of the most important measures of profitability of a company from a stockholder's perspective. One thing I like to do is break ROE into its 3 components using a DuPont analysis. So if you haven't seen my video on that, check that out in the description below. But let's jump into it here. So I see that ROE is pretty steady, bounces around a little bit. I hate to see that it has gone down in the most recent trailing 12 months, but hopefully that's just temporary. The net income margin, again, is pretty stable between 8 or 9%. And I see asset turnover is, if anything, I would say trending downward. I don't like to see that. So for every dollar of assets in place, they made 78 cents in sales in the most recent period. Hopefully that is only, temporary because of the COVID pandemic. The equity multiplier, this is the leverage portion of ROE. It's moderately high. So the company's making good use of their debt to leverage up and achieve a higher ROE. So yeah, I think their DuPont analysis is fine. I just hope that we're not seeing a permanent trend here. Hopefully it is just temporary, like a lot of industries are going through right now. So here's a visual of the dividends and share buybacks that General Dynamics has done. You notice in the orange we have dividends. You got that steady increasing dividend every year. But in addition to that, notice that they bought back a heck of a lot of their stock over the years. They haven't bought back as much this year, which I'm assuming is because they want to be careful and hold on to their cash because of the pandemic and the decreased demand in all industries right now. So, as we value the company, just consider you're not only getting that dividend streak, a substantial amount of money will also come back to you in the form of share price appreciation as they buy shares back. Okay, so whenever you look at dividends, you also want to consider the payout ratio. Because if a company is paying out, 100% of its profits as dividends, that is a dividend that is susceptible to be canceled, to be cut. Right now, we don't have that with General Dynamics. If you look in the green here, over the years, their payout ratio is around 30%. It's about 36% in the most recent year. So that means they're taking, anywhere from 64 to 70% of all the money they make, and they're not paying it out as dividends. They're reinvesting it in the business, or they're using it to buy shares back. So that dividend is not in danger whatsoever. Even the modified payout ratio, which I'm going to put the formula for that in the description below. But guys, it's essentially just the dividends plus the money they spend on buybacks, all divided by the profits for the year. And as you can see, despite all the money going into share buybacks, they're still retaining a lot of it, reinvesting it back into the business, meaning they can probably afford to keep these share buybacks up at this level for the foreseeable future. Okay, so the next thing that I really want to do is use an intrinsic valuation model to try and figure out what is the share of GD stock worth. Now, as we just saw, GD is a great dividend stock, but it also spends a significant amount of money on share buybacks. They are not a company that just takes all their profits and pays them out as dividends. Therefore, the dividend discount model really isn't going to work that well for General Dynamics. We're going to want to use a free cash flow to equity model. If we use a dividend model, we'd probably underestimate the value by a lot. So if you haven't seen my video on free cash flow to equity models, check that out in the description below. But basically the idea is pretty simple. The value of the company is equal to the stream of cash flows they're going to earn, all discounted back to present value. So to make the model work, we need to estimate what free cash flow to equity is going to be next period, and then how much it's going to grow by for the next 5 years roughly. Alright, so free cash flow to equity is kind of a modified net income measure. You take your profits and you make a few adjustments to that measure to get free cash flows to equity. So I'm looking here at the company's net income and their free cash flow to equity for the past 4 years. As you can see, net income is much more stable than free cash flows to equity. And if I just look at net income, I'm looking at a very modest growth rate at the moment, 2.27%, if I use a geometric growth rate over the past 4 years. I'll have to keep that in mind as I forecast how much their cash flows are going to grow by in the near future. Now, what I'm going to do to estimate free cash flows to equity for the next year is I'm going to take an average of the past 4 years because it bounces around so much. I just want to make sure I have a relatively stable measure there. Okay, so I have an estimate of next period's free cash flows to equity. I then have an estimate of how much these cash flows will grow by over the next 5 years. I'm going to choose a low percentage since historically what we've seen there is a 2.27% growth rate. I'm not going to get out of line here. I'm going to use a low estimate. At this point, all I really need is an estimated discount rate. The discount rate should reflect all the risks the company faces. The more riskier the company is, the higher the discount rate I should choose. It's inherently difficult to estimate these discount rates, so I'm going to use a number of different rates and just show you what the value would be, assuming a different rate. Personally, I see General Dynamics as having about an average discount rate relative to the S&P 500. The company is moderately leveraged. They have a major customer, but that customer is the U.S. government, which is very stable. The company has a long history of being able to keep their dividend streak going. So again, there's pros and cons. I'm just going to go in the middle. All right, so what I got here is a valuation matrix. Along the vertical here, I have different discount rates. So depending on what discount rate you choose, that would change the fair value of a price of their stock. And on the horizontal here, I have the free cash flow to equity growth rate that you're expecting to see over the next 5 years. Depending on what growth rate you choose, of course, that will change the fair value of the stock. So what you can see here is that the stock's trading at about $152 right now. Under the most pessimistic scenario, low growth, highly risky company, high discount rate, the stock would only be worth $118. The most optimistic scenario I'm choosing here is a 5% growth rate. I really don't think it's really proper to go beyond that when the company hasn't grown its net income by more than roughly 2% over the past 4 years. So anyhow, if this is the case and you got the lowest discount rate, the stock could be worth as much as $253 roughly. Another way of interpreting this chart is as follows. Let's suppose you want to earn an 8% return on your investment and you think that GD is going to grow their cash flows at 3%. That puts you in this cell right here. That means in order to get that 8% return, you need to pay no more than $145.97 for a share of their stock. So what I have below here is the discount or premium relative to the share price today, which is about $152. So for example, under the most optimistic assumptions, the stock would be undervalued by about 40% if we assume a 5% growth rate and a 6% discount rate. If we're on the most pessimistic assumptions, that puts us in this cell in the bottom left here, the stock would be 28.72% overvalued. So what you see here is pretty much a mix. There are more optimistic scenarios where you're undervalued than there are overvalued scenarios. This makes it a tough one. Which scenarios are more likely? Let's talk about that. So remember that GD is a government contractor. So how much military equipment the government demands is going to be a major determinant of their value. One thing to consider here is just how much the stock price jumped up around November 9th here. You notice that huge spike when we learned that Joe Biden was likely the winner of the presidential election. So that tells you something. Well, I think the explanation is obvious here. Trump, as you may or may not know, has been nominated for 4 Nobel Peace Prizes, and it's not for no reason. He's one of the only presidents to not start any new wars and to actually pull troops out. Now, whatever you think of that, whether you think that's great or not so great, you can see the implication for a company like General Dynamics. So why am I telling you this? Joe Biden's the winner, right? Well, not so fast. Recent news has come out, which is not really being covered by the mainstream media, but there's some court cases going on, and there's possibly some serious issues with the election count in some key states here. We have some lawsuits filed in Pennsylvania, Michigan, Georgia, and you can look up the evidence for yourself, although I would suggest that you don't use Google. Google tends to filter their results and you may not find what you're looking for if it's not favorable to their chosen candidate. But long story short, guys, there is a chance here that the election gets reversed, the outcome is reversed. Now, if the outcome is reversed, you're going to see a reversal in the stock price. I mean, after all, if the market was so excited about a new president, they're going to be just as unexcited about, the result that that's not going to happen. So let's tie it all together. Here are my final thoughts. Based on the analysis I've done, GD is a pretty nice looking company trading at a decent multiple when you look at their price to earnings ratio. They have a great dividend growth streak, and their balance sheet is, I'll give it a B. It's healthy enough. But when we try to estimate the intrinsic value of General Dynamics, what we find is a mixed picture. The value right now is not a clear buy or a clear sell. It really depends on what you think those cash flows are going to be able to grow by in the near future. So my recommendation would be as follows. Given the current share price of about $152, I would not touch the stock. The reason I say that is that the election results may in fact go the other way. And if they do, I expect those growth rates in their future cash flows to not be so rosy. And if that were to happen, you'd have a stock that would be pretty overvalued right now. But if in fact we do have an incoming Biden administration and the stock price remains at roughly $152, then you have a clear buy. So that's my advice for you. I hope you enjoyed the video. If you did, hit that like button. It helps me a great deal. Thanks for watching.